Welcome to my channel. I am the Covered Call Guy, and this is my journey to creating a $120,000 per year passive income portfolio. If you've been following, I am currently at 61,000, a little over $5,000 a month, so I'm halfway there. Before we get started, this is a disclaimer. All content presented in this video is for informational purposes only. And should not be considered financial advice. I am not a licensed financial advisor, broker, or professional. The information is provided is based on personal opinions, experience, and publicly available sources at the time of publication and may not reflect current market conditions. Trading and investment involves substantial risk, including the entire potential loss of principal or your entire portfolio. Okay, you should always conduct your own research and consult a licensed financial professional before making any investment or financial decisions. Past performance is not indicative of future results, and no guarantee of any specific outcome is expressed or implied. Okay, any strategies that I use is based off of my due diligence and my own research. None of it is recommendations. Views are my own and does not represent the opinion of any other party or organization. I make no warranties or representation of any kind of accuracy, completeness of the information provided. Please fact check me, fact check yourself, do your own research, do your own due diligence. All right. I'm just some random idiot you found online, and I could be completely wrong. So let's get started. Today's video is going to be my deep dive on my portfolio on my current stocks. Welcome the Covered Call Guys deep dive, the Covered Call ETF. Deep dive into the world of high income investing. We'll explore the good, the bad, and who this strategy is really for, using my portfolio as our guide. All right, how does a Covered Call ETF actually works? All right, we're going to break down the two-step process, right? So for example, I'm using the ETF that I currently hold, GPIQ, right? GPIQ buy the stocks, and in this case it buys the 100 stocks in the Nasdaq 100, just like QQQ. And then step two is sells call options, right? The fund then writes or sell call options against these stocks, right? This is selling a right to buy coupon base essentially, and the fund collects a cash, which we call a premium, for selling this coupon. All right, so then the cash premium collected from selling the income it gets passed on to us, the shareholders, as a high yield distribution. The ETF is just a machine for harvesting these premiums, so it collects it and it distributes to us, the shareholders, as high yield income. Moneyness changes everything. And what do we mean by this, right? Not all Covered Call ETFs are the same. Covered Call ETFs have seemingly got a bad rep. There are a few high yield Covered Call ETFs that, you know, that shows 50%, 70%, 80%, or even 100% yield, but you see that it completely destroys its capital appreciation or its NAV, right? So the most important detail is the moneyness of the calls they sell. This determines the fund's entire strategy. Is it built for pure income or a hybrid of income and growth? So you have to decide what you want, the stages of your life, the lifestyle that you want. All right, so we got at the money, ATM for short, 0% out the money, OTM, right? So at the money, the fund sell options with a strike price equal to the stock's current price. This generates the maximum possible income, but gives up all the potential for the stock to go up. So the pros, highest possible yield. The cons, 100% of upside is capped. An example is JPY and QYLD. These do 100% at the money. And why does it pay the most? Because the chances of it actually hitting the strike price and you have to sell it and give up is almost 100% guaranteed. And then we have out the money, OTM. The fund sell options with a strike price above the stock's current price, 2% out the money or 5% out the money. This generates less income but allows the stock to go up a little more before the upside is capped. Captures some of the upside lower yield than at the money. And I used my two examples, the two stocks, the two ETFs that I currently hold right now, GPIQ and GPIX. So this is important for how you guys want your portfolio to perform, right? So if you're okay with just the stock price never growing, you're just getting your money, it's whatever, you don't really care, just make sure it's consistent, you know, the NAV stays stable, it doesn't have to grow, you know, then JEPI or QYLD, it's something of, you know, fits your portfolio. Whereas for me, I like the strategy of GPIQ and GPIX where they don't cap the entire upside. So it could run, it could, the stock price could go up more, the payment, the premiums might not be as high but consistent, but not as high for the NAV to grow. So that's, I want a little bit of both. All right, so the great trade-off, the pros versus the cons. Like you heard it all, you read it, when you do your own research, you probably seen it before. There's no such thing as free lunch. This strategy is a direct trade. We are giving up future growth for cash today. This is the whole point of almost all cover called ETFs, right? We want the income, right? So the pros, the good, high income stream generates consistent high monthly distribution far above typical dividends. The downside buffer, the income collected acts as a small cushion in a falling market. The fund will still go down just less than the underlying stocks by the amount of premium. Works in the flat market. This is the ideal scenario. So all cover called ETFs works best in a flat market, unless you're probably talking about maybe WPay, which is leverage, so you want the market to boom. So there are some exceptions, right? If the stock goes nowhere for a year, we still collect 10 to 20% plus yield, while growth investor get 0. All right. The cons. Most cover called ETFs are capped upside. This is the big one. This is the trade-off, right? In a strong bull market like 2023 to now, these funds get left in the dust. The stock gets called away and we miss out on all the big gains. There is no real downside protection. There's a buffer, but there's no real downside protection. The buffer is small. If the market crashes 30%, a 2% premium doesn't help much, right? We'd still be down minus 28%. And then we got to talk about the tax, right? Tax inefficiency. The income is often taxed as short-term capital gains, which is the highest possible tax rate. And I'll talk more on that on the next one, because there is something called ROC. All right, the hidden tax trap. The income from this ETF is not the same as dividend. We call it a dividend, but it's not really a traditional dividend. This is the most misunderstood part of the strategy. It can lead to a nasty surprise from the IRS. There's multiple different types of dividends and how they're tax qualified dividends, right? This is the quote-unquote good income. Think SPY or VOO. This income is taxed at a special lower long-term capital gains, often 0, 15, or 20%, depending on how much your tax bracket is. And then there's the cover call. All right, the cover call is, it can be tax disadvantage. Again, I put it in the cons because you won't know until the year ends. This income is often a mix, but the premium part is usually taxed at short-term capital gains. It's the same rate as a job, and you know W2 gets taxed the most, which can be 37% or more. A 12% yield can become a 7% yield very quickly after taxes. So there's something to think about. You're gonna hear return on capital, which can be tax efficient, or the 60/40, or the Section 1256 contracts, which is very tax efficient, but you would not know until the end of the year when you get the full 1099 from your brokerage. All right, so this is just a deep dive on my portfolio. All right, my portfolio uses a core and explore model. All right, so GPIX, GPIQ, and QDVO form my core hybrid base. while I own MAGY and BTCI, which are my explorer or my speculative aggressive bets on high volatility assets. So it's not a accurate 20% in each. This is just kind of a graph to show my my portfolio. I don't have exactly 20% in each. Eventually it will probably be like 20 20 20, and then once these two get built out, I'm trying to aim for MAGY for $1,000 per week and BTCI to be $4,000 per month. They will probably be under 10%, and then I will start building out another ETF, which I have not yet come to. I will come to that point when I reach about $10,000 per month, and I will start deciding which route I want to go. So these three makes up my base. It's really GPIX and GPIQ, and then this QDVO is kind of my my hybrid play. It's more growth first, then dividend second. Let's see here. GPIX pays me about $23,000 a year. GPIQ pays me about $16,000 a year. QDVO, I believe, pays me almost 18 a year. MAGY pays me about 6,000, and then BTCI is actually my smallest position, which will be built out last unless it takes a good fall on the share price. I only have about maybe $3,000 in it. So right now I'm building out MAGY, and then once I finish building that out, I will build out BTCI. All right, let's do an in-depth on my core GPIX, GPIQ, and QDVO. Those are my core holdings in this portfolio. They're built with a similar, hybrid strategy, but their underlying engines are different. And what do I mean by that? GPIX is the SP500. It holds the SP500 stocks. They sell calls that are 2% out the money, and the hybrid is that by selling 2% out the money, it's designed to capture the first 2% of the markets plus upside. They don't do their strategy is very unique because they do 25 to 75% of their calls, and then they leave as much as 25%, up to 25%, to capture more or try to get the buffer if the market goes down. So I didn't mention that here, but I just want to put that in there. My take, this is my conservative hybrid. It sacrifices some yield, which I'm okay with. 8% is still very good. They do anywhere from 8 to 10%, which is still excellent, to get some market upside, and it's a bet the S&P 500 will have slow, steady gains. And GPIQ is essentially the same, but it does the NASDAQ, right? So it holds NASDAQ 100 stocks, also sells a call that about 2% out the money, and it has the same unique strategy that only covers 25 to 75% of its portfolio, and then leaves a lot of that up to as much as 25 to even more, depending on the fund manager, to capture more upside or have the buffer during a downturn. So the hybrid goal is the same as GPIX, but on a much more volatile index, which is why I mentioned here, I don't have that. It's the core, but I don't have that much into it. I will eventually build it out some more when I'm more happy with the price. Right now, the entire market has been going up. Not a bad thing, but I like to that dollar cost average. So it captures the first 2%, often explosive, plus upside option income, right? So this is my more aggressive hybrid. The NASDAQ is much more volatile. Obviously, you see the tech sector. So the premiums and yield are higher than GPIX. And it's a bet that the tech market will be volatile, but not have too many massive up months. So we've seen the boom. Now we're going to see the slowdown. And then QDVO, right? So QDVO is my NASDAQ 100. It holds the NASDAQ 100 stocks. So you're saying, why have two NASDAQ 100? Well, QDVO is a bit different, right? So the strategy here, this one is actively managed like all of them, but this one is really actively managed, right? So it sells call options on a portion of the portfolio, 50 to 9%, and can change the moneyness at the money or out the money based on market conditions. So they do about 20 to 40 stocks that the active manager pick. They decide on capital appreciation first, and then high yield income. So they have a two-way goal, but the first one is NAV growth. So it's a flexible hybrid aiming for high income while capturing some upside by not writing calls on the full portfolio, right? So the third take is that they're saying is a tactical core holding because it's similar to GPIQ, but we're trusting the fund manager's active decision to navigate the market instead of GPIQ's fixed 2% out the money strategy. So QDVO is special in that way, in that it holds 20 to 40 stocks that the active manager picks. So my trust has to be dependent on the fund manager here. And before QDVO, I owned DIVO from the same fund Amplified, but I just switched it over to QDVO because, you know what, double the yield, and I really like that fund, and I believe in the fund managers, so why not? And then my last two, right? So let's see here before going too much. MAGY is the Mag 7. It's extremely concentrated, so it's a synthetic ETF that simulates owning the 7 biggest tech stock. The call strategy sells at the money as 0% out the money calls on each individual stock. So it sells at this one sells at the money because we're trying to aim for the highest income possible, and it's extremely concentrated. And then we have BTCI that does Bitcoin. I absolutely love crypto, but the only crypto I really like is Bitcoin. I don't do any other crypto. I'm not sure in the future, but right now I'm sticking with Bitcoin. It is a synthetic ETF that simulates owning Bitcoin via future contracts. It holds the ETF, I believe, IBIT and hold. And the call strategy is sell at the money, zero out of the money calls. Again, it is aiming for highest premiums possible. Right, the income goal is to have pure income, and it sells 100% of Bitcoin's calls. All right. And of course, for Mag 7, this is pure income play. Like I said, it sells 100% of the upside for maximum premium income. It is an extremely high risk because it's concentrated on just 7 stocks. And then again, the Bitcoin, right, it swings so much upside and it swings so much downside, and there's a bet that Bitcoin will stay in a range and not go on its famous 100% bull runs while we collect all the huge yield. And it's a high yield, high risk play. Right, these are my two high yielders and high risk plays. Again, BTCI is speculative, so I'm building that position out last versus MAGY, Mag 7. I don't think Mag 7 is going anywhere. It's here to stay, and if one falls, it just gets rotated out. So I'm 100% high conviction believe that Mag 7 is going to stay. It's going to be here. All right, so my simulation, my GPIQ versus growth. Again, I just did one simulation. I just chose GPIQ versus the growth. So I'm comparing my core GPIQ against QQQ. So in a flat market, QQQ absolutely gets destroyed by my GPIQ, right? So this is all hypothetical data for illustrative purposes only. It could be completely wrong, but I'm just using the data in a flat market. Obviously, flat market growth does not go anywhere. It stays flat, but flat market is best for GPIQ. What happens in a bull market? We get absolutely destroyed. In a bull market, the growth stock, pure growth, will win. It's without a doubt. Cover call ETFs will not beat any growth stock in a bull market. Well, what happens in a bear market? Well, in a bear market, GPIQ in a sense should perform better because of its strategy, it leaves as much as 25%, maybe even more, depending on the active managers, to capture and buffer some of the downside. Now, again, this is hypothetical. We don't know what's going to actually happen because one comes down to the premiums, right? It comes down to the active manager and how they execute. So this is just a chart of what could happen, not will happen. All right, let's do a real world stress test. How does this strategy hold up in the real world? Let's look at today's major economic events. So this is real news, real data stuff that I pulled and put together, right? Scenario 1 is persistent inflation and high rates. This is the flat market scenario. High rates tend to pin down the stock market. That's the best possible environment for cover called ETFs. Growth investors get nothing while we collect our high monthly income. Scenario 2, the AI revolution and tech boom. This is the bull market, which we're kind of experiencing, right? The AI causes the NASDAQ and MAG 7 to soar 40% in a year. This is the worst possible environment as QQQ, the growth investors, double the money. GPIQ captures the first 2% of his yield. MAGY selling 100% of the upside and gets left completely behind. We missed that rocket ship. We missed going to the moon. Scenario 3, layoffs, slowing job growth, and recession. This is the bear market scenario. The market crashes. Our ETFs will crash, and I quote here, almost as hard, depending on the active manager and depending on the strategy, how they execute. The income we collect provides a small 2 to 5% buffer. Could be more, could be less. All right, this is what I'm just using conservative numbers here, right? But we are not losing significant capital, right? This strategy is not a hedge against recession, okay? Just like growth cover call ETFs will get absolutely blown out. Look at the April tariff, right? But we recovered. We still got paid, but we still fell, just like the whole market did. And now we talk about the tax efficiency. What is return of capital? All right, this concept is crucial to understanding high yield ETFs. When we get a distribution, we assume it's profit, but sometimes it's just a fund giving us our own money back. This is return of capital. That is the easiest way to understand this. Imagine we invest $100 in a fund. At the end of the year, the fund had a bad year and made zero in profit, but it still promised 12% yield. To pay us, the fund takes $12 out of our own original $100 and hands it to us. We think we made a 12% profit, but our investment is now only worth $88. This is what we call destructive return of capital. The fund is eating itself to pay the yield. Well, why does it matter? Right? So when I say always check the fund's section 19A notice, if a large part of the yield is ROC, it's a red flag and the fund isn't actually earning the yield it's paying. And as you know, there are some extremely high yielders out there that does this. And you'll see the NAV erosion. That is destructive return of capital. You don't want that. You want to stay far away from investments like that. Miss anything? Okay. My verdict. Who is this strategy really for? So after all, this is an income strategy or a growth strategy. The answer is neither, right? It's a volatility strategy. This strategy is not for young growth investors, right? The number one mistake, the 25-year-old should be praying for bull markets, not covering the upside for a little income. I would put myself in the young but not growth investor because of the AI. I believe that, if you can work, then this is not for you. It is not for true retirees. This strategy has all the downside risks of the stock market, and the traditional retiree needing safe income should look at bonds, not an equity derivative fund that can crash 30%. Right. So if you're not willing to go for the swing, this is not for you. And then the market timers who they can jump in and out. Yeah, you're fooling yourself, because you shouldn't be timing the market. So it's not for young growth investors that want to just buy the underlying and work 20, 30 years. This is not for you. Who this strategy is for? Well, it's for people like me, right? The near retiree. Although I'm in my early 30s, retirement is not an age. It is a financial number. This is for someone who is about to retire or trying to retire and want to supplement their income. I'm trying to replace my salary, and is for someone who's okay with market risk. I'm okay with that. They're trading some of the upside to get predictable cash flow now, which is what I'm trying to do. I can get laid off tomorrow and not get a job, so this is going to be for my retirement. The flat market believer. All right, so an investor who genuinely believes the market will be in a range bound for the next 3 to 5 years due to inflation, high rates, and slowing growth. Yes, I'm starting to see the growth is slowing, the inflation is still high, the rates are being cut, but nothing is actually going down. So this is a good three mix. I believe the market has run up a lot. I don't think it will continue to keep running up. I believe at some point it will go down, start doing a choppy up and down, up and down. And this is for the income-minded active investor, an investor like me who understands the trade-off and is actively using these tools to generate cash flow. So I'm using the money, reinvesting to create more income, to start splitting up my ETFs into other ETFs. So as soon as I start building out one position, I go into the next, and I could look into safer ETFs, safer, quote unquote, safer income ETFs. All right, the cover call, guys. Note this portfolio I'm showing is a fascinating mix of GPIX, GPIQ as my core income plays, MAGY, and BTCI as my extremely aggressive high risk bets. An investor with this portfolio is essentially saying, I believe AI and Bitcoin will be volatile, but not going up too much or too fast, right? So this is very specific and high risk thesis. I believe it's going to be there for a while. If it runs up, and it runs up quick, either way, I get the income. I do own some Bitcoin myself, so in that sense, my actual Bitcoins will go up while I collect the income, right? So I'm harvesting volatility from some of the most growth-oriented assets in the world, which is the highest stake trade-off. It's not for everyone, but it is exactly what we're here to analyze, and it's based on my portfolio. Again, my portfolio is based off of the lifestyle I want to live. It might not be for everybody. I understand that. The risk and reward, the tax implications. If you want growth, this is definitely not for you, right? Again, a lot of this is going to be what you want your lifestyle to be. I want to retire as early as possible. I want to replace my income as quick as possible. I want to enjoy my life. I want to live my life as quick as possible in the sense of, speaking. I don't want to wake up from an alarm clock having to go to work. And so I'm using this portfolio that I have built right now to try to reach my income goal as soon as possible. Thanks for watching. I'll catch you guys on the next video.